Welcome to the daily update where I'll go over the action in the market for Tuesday, February 25th, and we'll see how things look for Wednesday, February 26th. Okay, saw a down day, but at least in Tuesday's session, we closed up off of the low. So we did see some strength as the day finished off. So also, the 100-day moving average, the exponential version, is still holding. That's about where we set the low in Tuesday's session, and then we were able to bounce up off of that. We're also seeing some improvements still internally inside the S&P. It's not growth, it's not the mega caps. In fact, we're seeing growth, discretionary, and those areas that really help the market to go up. We're still seeing weakness in that as the market's turning more defensive. But the rest of the S&P is actually showing some strength. Now, this could be more of these defensive areas. So that's what we're trying to figure out as each day goes by. Is this a shift like we saw at the end of 2021 going into 2022? Or is this something that's more short term that'll get dealt with and then we'll be able to bounce up out of that? All right, let's go back and talk about what happened. Right at the open, we had a flat open, and this is what we saw on Monday. Most of the price action is coming while the session is open, where a few weeks back and a month or so ago, we were seeing usually big up moves or even down moves when we had those real big gap lower opens. That's happening before the market even opens, and then we gap higher, gap lower. We're seeing most of the action taking place while the stock market is actually open. So that's showing more conviction with investors in the US. So it was pretty flat. It was actually a little higher in Monday's session, but on Tuesday it was a flat open and but then we just started right out of the gate going down. We fell below S1 at 59.60. So now we've fallen under the 6,000 level. We fell under S2 at 59.36, but we found support at right around the 100-day exponential moving average, which is at about 59.17. So now if we keep falling, now we're going to be watching the 5,900 level. And if we go up, we're going to be watching the 6,000 level. Now, these are round numbers, but the more we play with these particular levels, they actually become technical instead of being just psychological. Then, as the day went on, we kind of hung around the 100-day moving averages there for a while, and that built a base. Now, a lot of times when this base happens, it could be just cooling off or a little bit of a rest before we break and go even lower. Well, in Tuesday's session, the base was built, and then we were able to climb up off of that. We got back above S2 and S1, and we chopped above and below S1, and we closed slightly below S1. So we were down 0.47%, where at one point we were down over 1% with the S&P. So we repaired a lot of those losses, and volume was above average. And we are negative in the short and intermediate term. We're now trying to deal with the intermediate to somewhat long term by dealing with the 100 period moving averages, but we're still positive in the long term. And I measure this according to moving averages. Now, we're going to get an inflation report on Friday, the core PCE, but that's still a few days off. And interest rates are going down as more of a flight to safety. People are getting out of stocks and getting into bonds. When they're buying bonds, that pushes prices up and interest rates down. So this play between interest rates and stocks that we see a really high correlation between the two, that's starting to wear off, at least for the last few trading sessions. We'll see if that continues. At some point, if interest rates start to really drop, then folks won't be as attracted to the bond market saying, hey, I can lock in this higher yield right now. Well, if the yield keeps going down, 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 they're going to not be interested in that anymore. And suddenly they're going to look back over at the stock market and go, okay, well, we've fallen pretty far, pretty fast. Some of these really big companies that have really done well, they're suddenly looking good. Let's go get back into the stock market. Now, we don't know if that's going to happen on Wednesday. We don't know if it's going to happen over the next week or two or a month or two. These are just different scenarios that we watch unfold as things are happening and then evaluate where things are at. And of course, all the geopolitical things going on there with the executive orders, with Russia, Ukraine, with US, and all these negotiations that are going back and forth, and Doge and executive orders, and all this stuff that's going so quickly right now. And you also had this big rollout of AI. I mean, just look at what's happened over the last couple of weeks with things coming out of China and things coming out of the US. And now you've got Grok coming out on X, which is Elon Musk's AI, which is kind of the considered to be the best, at least for this week. Then next week it'll be replaced by something else, probably. And there's real heavy competition in that, and things are happening fast and fierce in that area. So we've got so many changes going on right now that it's so hard to keep up with things. All right, some comments. This shift over to being more defensive is continuing for right now. We're seeing growth and discretionary weakening. Now, they haven't actually switched over and turned negative, but we are seeing weakness in this area or in these areas, and we're seeing the more defensive areas show some strength, and I'll talk more about that. And then the different, I'm calling it tariff tiffs because it's a lot of people just don't understand how Trump negotiates. He throws some wild idea out there just to get folks to the table and say, okay, this is a starting point now. Well, people that don't really know what he's doing or really pay attention to what's going on, they freak out over his initial statement, not realizing that, hey, this is a negotiating tactic, and we'll probably calm down from that and we'll try to reach some middle ground on how things are going. They don't realize there's more steps beyond this in there, and that it's not having as big of an impact. It's still having an impact on the markets, but the stock market is now learning that, okay, just because these things are announced doesn't mean that's the end all. That's kind of the starting point. And then there are some growth concerns coming into the economy. We're seeing some economic reports that are coming in weaker than expected. And also, we can apply this over to earnings for stocks as well, that they're still looking to go up into the future, but they're slowing down. And we're not seeing this explosive growth that we were seeing before. And then there's a lot of diplomatic tensions going on as the Trump administration is looking at tightening restrictions on chip imports, the semiconductors, to China. So we've got that coming up too, and that really hit the semiconductors hard. But then there's all these other things going on all at the same time that has things kind of unsettled right now. And if you like what Trump is doing, you're really happy right now. If you hate the guy and you don't really understand what he's doing, you think he's really evil. And there's that battle that's still going on back and forth. So far, at least to this, both the 100 period simple and I should have put the EMA here, the exponential moving average, are holding for the time being. The mega caps and Tesla just got hammered. We're really seeing underperformance with the mega caps and Tesla right now. And it was announced that European sales for Tesla were down 45% on a year over year basis when you calculate what happened in January. And now our list is getting a little bit longer. Now, as I've been trying to warn here, and just doesn't mean this is what's going to happen. I just want you to be aware of this, that we're seeing some short-term oversold. That's what ST over OS means, that we've gone down pretty far, pretty fast. But it doesn't necessarily mean that we're going to immediately go in the other direction. But it doesn't mean we're going to stay in this condition for very long, because the bigger picture is that we're still positive. When you look at the long-term trend, as I measure by using a 50 period moving average and a 200 period moving average, when the 50 is above the 200, that's an uptrend. And it's a very common thing that people use, and I've used it for decades. And when we see a counter move in the opposite direction, we tend to not have that last for very long. We kind of, I also explain it this way. When we're in an uptrend, some of the biggest down days you will see or down periods will come in the midst of a bigger uptrend. That's the COVID crash. We were in a solid uptrend right when that thing hit, and we just tanked and then V'd right up out of that. We just bounced right up out of that and then continued with the prevailing trend. It took some time and it freaked out a lot of people, and a lot of things were happening at that time. Just like when we're in a downtrend and it looks like we're bouncing back up and we're getting to an overbought condition, that tends to not last very long. We might hit a resistance level, a 200-day moving average, a 50-day moving average, a pivot point, and then we turn and then start going back in the other direction. So we tend to default to what is the prevailing or bigger trend in the bigger picture, realizing that counter moves, we want to just watch for those. Now, if we are shifting over to a more negative environment where eventually the long-term trend is going to turn negative, then yeah, this could probably last a little bit longer. But we don't know that yet. We've been at this point before over the last year or so where it looked like things were really starting to go negative, only to hit support and then bounce up out of that. Now, Nvidia is going to come out with their earnings on Wednesday. I think it's after the close. And that's like the big earnings report that everybody's waiting for now. What happens if their report is really taken well and the futures just really spike up after hours? What is that going to bring money back into mega caps? What if their earnings report is disappointing or their forward guidance isn't what the market is hoping? That could tank things even more and turn us more negative. We don't know. That's why I don't play earnings types of situations because that's gambling. You're just rolling the dice at that point. And even if it's a good report, the market might tank. And if it's a bad report, the stock may go up. So there's never any guarantee that A plus B equals C. There could be a whole different equation that's being played out. Okay, but in the short term, we're looking pretty negative right now. The VIX has really spiked up. In fact, we were up over 20 at the early part of Tuesday's session. That's when things tend to turn more negative. But we didn't stay there. We ended up dropping down below 20. But the VIX that we use to measure the speed based on an RSI 9, that's starting to get extreme now. And I'll show you that chart. And then we have our other short-term indicators, the Stochk RSI, the Williams percent R, CCI 14, which is more really short term, and then the 20, which is a little further out short term, and the stochastics, as well as the force index. These are all giving us extreme negative readings. It doesn't mean we're done here, but it doesn't mean that we're necessarily going to stay here either. We could bounce up out of this. And then no change to the scenario. It's probably not going to change until Friday when we get the core PC. And then even then, it might not change after that. The dollar was up and interest rates were down. We're dropping with the 10-year yield. We're at 4.3% now, where we had been at 4.39%. And we've been battling over a week ago with this 4.5% level, and the stock market was really keying off of that. Well, we're below 4.5% now, and the market's not keying off of that. They're worried about other things right now, and that's how these things can shift and ebb and flow. So to try to come up with a scenario that's always true all the time, it doesn't work that way. The market could be really focused on something at one period and then shift its focus to something else. All right, sentiment is now extreme negative. This is the point when we drop under 25, when we say, okay, people are pretty pessimistic right now. Let's consider things moving the other way. Since we're getting extreme negative below 25, now this becomes at least the idea of being a contrarian indicator. Now we could still fall further than this, but we could also bounce up out of this as well. And we are negative with a trend. We're pretty much a negative across the board in the short and intermediate term right now. And our ADX is also negative with the red line above the green line, but we're now starting a trend and we're above the moving average. But we're still below 20, so it's not an official trend yet. But I tend to use the moving averages, which are dynamic, where 20 is just a static number. I wish there was a way we could adjust that and say, okay, sometimes 25 is a good number, other times 15 is a good number. I've tried to play around with that over time. I just kind of settled on 20 as the general area for that. And because of the down day, our bias is negative, and then the last 2, 3, 4, 5 days taken together, that's our momentum, which is also negative. All right, we did get consumer confidence, and this is being cited as part of the negativity. we were already going down. This report came out 30 minutes after the open, and we were going down already. This, you could say this fueled it. Sometimes this comes out and the market doesn't even react to it. Other times they're like, oh my gosh, yeah. Well, there was a big drop here. They expected it to come in at 103.1. It came in at 98.3. That's a pretty big drop. Here, where the last reading we had was at 105.3. And there's worries about the tariffs. Folks are uncertain about things. Things are changing so fast. There is a real expectation that inflation is going to pick up. I mean, we're seeing commodities going up and we're seeing different things happening and the price of eggs, things like that. And then future employment prospects. It's like, well, if I need to get a new job, it's not as readily available as I thought it would be. And then we also had the FHFA Housing Price Index. It came in up 0.4%, which is the same reading we saw last time. The Case-Shiller Home Price Index was at 4.5%, where last time it was at 4.4%, and up from the 4.3% that we saw last time. So housing prices are still going up. Here's a chart of the FHFA House Price Index where it's continuing to go up here, and that could be pressuring the real estate market because, yeah, you might have a house that's going up in value, but how many people could come in and afford to buy it from you if you were trying to sell it? And then the Case-Shiller Home Price Index, this has actually been coming down when we look at it this way. And then the next chart also shows on a year-over-year basis how it's starting to go back up. So this previous chart is more month over month where it has, but we're seeing a contradiction here. Here's the FHFA index, it's going up, and oops, I'm hitting the wrong one. Or the Case-Shiller Price Index has actually been trailing down. So it's like, okay, how do we make a decision from this? And then consumer confidence here, where the blue line is the total reading, which it's really dropping off. We're still above 100, but it is coming down. And then how people are feeling right now, the purple line, there's some unsettled things going on. And then looking out into the future, folks are dropping down too. There's so many changes going on right now. And even though people say they want change, they really don't. And as long as change happens to somebody else, it's like, yeah, I believe, we ought to cut all these jobs in the federal government, but not mine. I don't, it'd be nice to clear up some of this mess and some of this corruption, but not where I'm at. Those kinds of things. And it's a very common human emotion to have. All right, then Isabel Net, we get this once a week, the overbought, oversold composite, and it's coming down. We're at 63, so we're not necessarily extreme. It's a little more negative because this has been coming down from recent readings. And then hedge funds and mutual funds have lifted exposure to U.S. equities. Okay, they've been trying to buy the dip, and that's where sometimes it's hard to tell the difference because we try to look at the true smart money. Now, hedge funds can come in because they have a lot of money and they can appear to be the smart money, but they're not. They're just the big money. And they've been buying lately. They're buying into stocks right now. And then this, you might want to pause this. We get this chart from time to time. This is taking the PE ratio, the price to earnings ratio, where we use a 10. 10 and below is inexpensive. Between 11 and 19 is considered to be fairly priced, the Goldilocks area. And then above 20 is considered to be expensive. And it breaks it down in different areas on what is the current PE ratio right now. So if there's different areas that you're seeing right here, if you use this as some kind of a decision-making tool, you might want to pause this and look at the chart. I don't. I use this more for information because we can stay at an elevated PE ratio for a long time. The mid caps and the small caps have been at fair value for a long time. Now, if you were using decisions or you were making decisions based on the PE ratio, you would be in mid caps and small caps right now and not doing very well. All right, then the US share of global equity in the market, it's about 56%. Earnings account for 44%. Mega cap growth and tech positioning still showing this chart as money's coming in. Now, these areas have been underperforming, and if they continue to underperform, we're probably going to see money coming out of those areas. Central banks gold rush. This is what's doing a lot of the buying in gold right now. are the central banks all around the world, where we're actually seeing private investment going down. Jewelry, it's like, okay, who can afford a gold watch right now? And industrial use has actually been declining. This is more because gold is seen as a hedge against insanity or as well as inflation. And central banks, whether it's the European Central Bank, the Bank of Japan, the Fed, they're coming in and doing a lot of buying. And then, of course, there's been this other interesting development where there's supposed to be a, Al Capone's vault Geraldo type thing happening at Fort Knox. We'll see if something like that happens to see if we open the door, is there really any gold in there? That could be kind of an interesting thing. And then the economic surprise index, it's been dropping off as some of the economic reports that have been coming out have been weaker than expected. And that's part of the growth concerns that I alluded to a moment ago. And then this is commodity trading advisors' exposure to equities. They're still getting in too. Okay. So, at least according to this chart, this is as of last week, though, before we saw the big down day on Friday. And so far, this week, this is probably going to change. And now another chart that I used to show in the intermarket analysis video every week was lumber, especially back during the COVID crash and the lockdowns and everything. Lumber was just skyrocketing. Now, part of that could be because people were doing all these home projects and they could run down to Home Depot or Lowe's or something and buy some lumber and go build that shed in the backyard or make a deck, something like that. But now it's more of tariffs and import export relationships and supply chain issues. And so lumber's been going up. So what I'm going to start doing every week when I do the intermarket analysis video, I'm going to re-include the lumber futures because the chart was getting really wonky there for a while and they actually changed it. So I dropped showing the chart. Now it's had a little bit of time to work its way out, and I'm going to start including that again. But this is inflationary with lumber going up. Now, systematic equity positioning. This is the idea that you use a system. Maybe it's dollar cost averaging, where you put in a set amount every month or every couple of weeks, and you just do that. No matter what the market's doing, you just systematically do that. And that tends to perform a little bit better when we go through difficult times in the market, where the other kind of doing the other way of doing this would be more of a discretionary way of doing this. Well, I think the market's looking positive now. I think I'm going to jump in. Well, a lot of folks, they don't really use technical analysis. They do things based on a hunch or on emotions or what somebody tells them. It's discretionary, but it's not very systematic, and that's where you kind of get over into the gambling side of things again, and that can really underperform as an approach when we're having difficult times. And so far, 2025 has been challenging. We really haven't gone anywhere, and now things are starting to turn more negative. And if people, well, I think we've gone low enough. Well, people thought that after Friday, and we've already declined more since then, another whole percent. Where a systematic approach tends to hold up better even during difficult times. I didn't spend any time on Twitter or X on there. I'm too busy doing my own research with my own charts here. But here's the intraday chart where, yeah, you go back to last Thursday. That seems like the good old days when we were above 6,100 here. Well, we fell down on Friday. We tried to open higher on Monday and then selling came in. We did try to bounce, but it was possibly too early. And you could also say that for Tuesday as well. But this fizzled out. And now I'm thinking this was right around the 50 period moving average for the Dow. That was about the high that we set for the Dow because we don't always hit support or resistance for the S&P on the S&P itself. It may come from another index. That's why we will watch a lot of different indexes here. And then we saw late day selling on Monday. Well, we had a flat open and then we just saw the selling coming down. We immediately came down below S2. This is right around the 100 period moving averages. And this is what I say. We were able to set up some kind of a base here. We tried to break up, came down, this held again. Then we saw things improve, but it was still earlier in the day, and this kind of fizzled out as well. But instead of seeing late day selling, we were able to maintain price above and below S1, and then we closed just a little bit below S1. And we're up, but we've been up. We were up on Sunday before the futures opened for Monday. We were up before two. Well, we ended up being more flat, but we initially were positive, and we're up again with the futures. This is the initial overnight session, which is this pink area here. And this is now turned negative, where we see the blue line below the red line. This is the blue line is large cap growth, which is now underperforming large cap value. And you can see this is just taking a massive hit down here with this blue line falling. Has it fallen too far too fast? Is there going to be a point where this buy the dip, which I don't do, I just watch other people do it because you can get burned. It's like standing in front of a freight train thinking that you standing there is going to stop it. Well, there is the smart money that can come in and stand in front of that freight train and actually get it to slow down, stop, and reverse. But individual investors by themselves just don't have that ability to do that. But this is turning more negative now with the blue line below the red line. And this, we've actually surpassed the low set back in January. I'd been pointing this out as looking positive because we were seeing this really going up. We've lost that now. We've actually dropped below where we were back at the end of January. So on an end of day basis, value was actually up, or growth was down over 1%. We were down with the mid caps and up, but up less with the small caps. And so we're seeing a real hit to our growth to value ratios here with the small caps still in an uptrend, but falling down. We're seeing a lot of London Bridge here. London Bridge is falling down with the mid caps too, with the growth to value ratio. And even S&P growth to value still in an uptrend, but London Bridge is falling down. I teach English to Chinese children, so I have to deal with these songs a lot. That and Let It Go by Elsa a lot, and Yellow Submarine. Oh, that's another favorite. And then we look at growth versus value here with the ratio. We're falling deeper into the rainbow as growth has been seeing weakness. Now we're seeing strength in staples right now, and we're not seeing an awful lot of weakness here with discretionary. But look at how over the last few sessions, staples have just been going up fierce, and that's sending the discretionary to staples ratio down. And we're losing more support here. We've fallen underneath the 100-day moving average here with large cap growth as growth has been getting hit. Are we going to come all the way down to the 200-day moving average? We got close last summer. This was the end of the world day right here. And then finally, the smart money came in and said, okay, we've had enough. Let's go in and start buying. And then we were able to bounce up out of that. But we don't know if we're at that point yet. Now we are negative with the trend. The red line's going up, the green line's going down. We're above the moving average, even though we're still below 20. This shows a strengthening trend, but it's not officially a trend yet. We're also negative in the short term. Red line going up, green line going down. The ADX is getting stronger above the moving average. And we're above average with volume. Now, the Ulcer Index is starting to go above the moving average. So we're starting to see some fear. This is another sentiment gauge. And the VIX, which got above 20, if you look at the bar chart down here, and that's when we were dealing with the 100 period moving averages. Well, we were able to climb back down from that. And on a closing basis, we're still under 20. But we're moving pretty fast. This is the RSI based on 9 periods with the VIX, and it's starting to get extreme positive. As the VIX has been going up, that means that stocks are going down. And the VIX of the VIX also going up above the moving average, both with the bar chart and the line chart. The momentum of the VIX is now up, which is negative. We're still getting a high reading with the skew index. Now we're dropping down here, but we're still in this red area. And we're seeing a bit of a discrepancy here, mainly because we're seeing some strength in bonds right now. So this fear gauge actually went down, or the other fear gauge went up. And we're really dropping off here with our risk on versus risk off ratio. It is really coming down as the market's getting more defensive currently. And we did go up with the daily chart of the equity put call ratio. We're going up with the 5-day chart, which is negative. We're going up with the 10-day chart, which is also negative, a little longer term. We're still going up above the band here with volatility risk premium as the market is starting to price in more fear looking out 30 days. But the advanced decline line, see, we were up based on price. This is the rest of the S&P that actually showed a little bit of an improvement. But because the big stocks are getting hammered, that's why we're seeing volume going down. So we're seeing a bit of a negative divergence here. We're going up based on price, but down based on volume. But longer term, we're still positive because we're above these advancing moving averages. And we showed a little bit of an improvement with our advanced decline over 10 periods. It ticked back up and it's back above zero. After Friday, we had dropped below zero. Even with the down day on Monday, we saw some strength coming in here, which is not as strong on Tuesday, but it's still going up. And the advanced, or excuse me, the new highs, new lows. Look at the number of new highs. These are the rest of the stocks in the S&P that are generating new highs. It's not just the Magnificent Seven stocks right now. So we see a lot more green than red. And so our 5 days going up, and we're trying to turn back up here with our 10 day as well. So there's internal strength, but it's more defensive strength rather than growth strength or offensive strength, I guess you could say. We're still looking good here with the advanced decline ratio. Both short term, that's blue, and intermediate term, that's red. Both are above zero and went up. And we're flat with accumulation distribution, and we're still above the moving average. So now this is looking more positive, but we have three smart money indicators. This is only number one. Number two is still negative. The Chaikin money flow, we're going down with the histogram, we're going down with the red line after getting really an extreme reading here. So this is negative. We follow what the red line is doing to determine if it's positive or negative. And we're also going down with the Chaikin oscillator. So two out of the three of our smart money indicators are still negative. Now, this is interesting because after a Monday with the big down day, the vortex actually turned positive and was showing strength. Not on Tuesday. Now we're seeing the red line back above the green line. The green line's going down as the red line's going up. So this is switched back over to negative. But we're not seeing much of a change here with the cumulative advanced decline line based on price. We're just chopping along. It's not really moving with the index. See how the index has been coming down? This has not been moving. We are seeing a bit of a hit with volume because the bigger stocks account for more volume, and those are the ones that are getting hit right now. So, but you could also see a negative divergence here. We're falling faster with volume than we are based on price. You could treat that as a positive divergence, saying that maybe price is holding up a little bit better here. And we actually went up with the NYSE advanced decline line where the S&P was down. And looking at the cumulative advanced decline line for the NYSE, this is falling, but it's still above its 50-day moving average, but not really moving all that much here with our regular NYSE advanced decline line or this other NYSE advanced decline line. The common stock based on price actually ticked up a little bit, but we're declining here based on volume. A little bit of a discrepancy there. Now, when you look at the advanced decline line for the S&P, it actually went up and it's holding up better. And we turned up just a little bit with the common stock on the NYSE, but we're below the moving average and flat with the mid caps. We actually bounced up slightly with the small caps. And then we look at the broad market measure of the 5 period moving average of the highs and lows. We're still below zero. So that's more intermediate term negative. And we're below 50 with those stocks in the S&P above their 200-day moving, excuse me, 20-period moving average, but we ticked up. We ticked up after Monday as well. These are I'm concluding, these are the defensive stocks that are showing some improvement as the growth stocks are getting hit. And we actually came down just a little bit with the 50-period moving average study, but we're still above 50, so that's positive. And we're showing an improvement here with the 100-period moving average study and the 200-period moving average study. To see a down day and to see these go up, there's some strength building under the surface of the S&P 500, which looks to be more defensive right now. Is that going to continue or is it going to finally end and the smart money come back in and start buying growth? All right, short term, and as I've been pointing out, we're coming up to the beginning of March here, so we've got the new pivot points, which are already there. So it makes this chart kind of hard to read, and we are above average with volume. We actually went up just a little bit with the 20-period, 50-period, and 200-period exponential moving average of the S&P. We're still extreme here. These are the short-term touchy indicators that I talked about where we want to be careful with this. When we're in a longer-term uptrend, sometimes we don't stay here for very long. Doesn't mean we're just going to hit and turn and go the other way, but be aware of that. We're extreme now in the negative sense with the Stochc RSI, the Williams percent R, the CCI 14, and the CCI 20. And we're no longer extreme positive in the short, it was a long term stochastic, but now we're still extreme negative in the short term, coming down and not quite extreme in the intermediate short term, and no longer extreme positive with the long short term stochastic, which, as I like to point out, this is a further subdivision of the short term time frame. We're still extreme with the force index hitting the lower Keltner band, and Keltner bands are very similar to Bollinger bands. And we're seeing a further deterioration of the short-term trend. We're below the 20-period double and triple exponential moving averages, and the lines are now coming down. So that's turning things more negative. We're below the 20-period simple and exponential moving averages, and the lines are starting to roll over as well. We're in the -2 channel with our standard deviations chart. And we're coming down with the balance of power. We're still above zero, but the context is that this is turning more negative. And we're negative again here with the brown bars with the go, no go system. And now instead of dealing with the highest high value on this chart, now we're starting to deal with the lowest low value. So that's turning things more negative. And then I drew in an additional anchored moving average here, but we actually dropped below this other anchored moving average. So this is more shorter term support that we've lost, but there's other levels down here and all the lines are still going up. So we'll just see if we keep falling, are we going to hit one of these other areas and will they act as support? And we're starting to move quickly again here. This is very common when we start a trend to see standard deviation picking up too, where standard deviation measures the speed, whether it's up or down. And we've been declining kind of quickly now over the last 10 periods. And so we're going back above the moving average here. And we're declining below zero with the ease of movement. And the Arun has now turned negative. Finally, it woke up and said, "Oh, there's a lot of selling going on here and not much buying. I'm going to calculate the difference between the two and now drop below zero here with the oscillator." But this is interesting. The McClellan oscillator for the S&P actually went up and crossed back positive. So we're just kind of floating along here with the summation index based on price, but we're still declining based on volume. And we did improve, but we're negative with the McClellan oscillator for the NYSE. So we're still going down with the summation index based on price and volume. We're still declining with the Swinland trading oscillator based on price and volume. And we're crossing below zero. That's turning it more negative here based on volume. Momentum is measured by the PMO. That's now negative. We're going back down based on price. We're rolling over, but we haven't quite crossed below the moving average based on volume. That's still hanging in there, slightly positive. Then we look at all of the PMOs inside of the S&P, and we're actually seeing a few of those rising. The buy signals are flat, where normally you'd think they'd be declining, and we're flat and slightly declining, though, with the PMOs that are above zero. We're negative with the Elder's Impulse system for the S&P. For 2 days now, we've been negative with the parabolic SAR. This is a primary indicator that has now turned negative. And slope, a short-term oscillator, it's now declining, so that's negative. The MACD is going almost straight down like it fell off a cliff. That's negative. So our momentum oscillators here, we're negative in the short and intermediate term. We're starting to turn more negative with the long term. And the long-term oscillators are the TRIX and the KST. And then another momentum oscillator is the Copic curve. That's negative. And we're coming down here with the Sean trend meter, not getting an extreme reading currently, but the context is that we're going down. We're declining, but still above 50 with the money flow, where we're dropping below 50 with the ultimate oscillator, coming down to the moving average with unbalanced volume. Now, it's still positive until we cross below the moving average, and then we see the moving average rolling over. And we're negative though with the RSI 14, which is more intermediate term, and the RSI 9, which is short term. We're below 50 and declining. Now we look at the condition of the intermediate term trend. The lines are starting to come down as we're below both the red line and the blue line, and we're below the 50 period simple and exponential moving averages. Now we're starting to follow the 100 period moving averages, and this red line is the exponential version. And that's the support level that was held on Tuesday. We kind of sliced through the simple moving average, but we held on to the exponential moving average. But then we were able to close back above the simple moving average, 100 periods there. So this support level for right now is holding. Now we came into this earlier in January. We kind of saw this before. We came right down to the 100 period moving averages. We dropped below. We hit a pivot point here, but we were able to close back above both 100 period moving averages, and then we close above them again, and then we were able to take up, take off up out of that. There we go. Is something similar to that going to happen this time? That's what we're watching right now. Because if we really break below the 100 period moving averages and close below them, that would turn things more negative than what we saw in earlier January. So looking at all the moving averages, we're below the 20 and 50s, and now we're dealing with the 100s. And we're going down with the bullish percent index. We're still above 50, so it's considered positive, but the context is that we're going down, so that's negative. And we're declining below 50 with the NYSE bullish percent index, declining but still slightly above 50 with the NASDAQ 100 bullish percent index. All right, now I haven't shown this in a while, the Ichimoku cloud. Sometimes I call it the itchy and scratchy cloud. We're coming down to the green part of the cloud. This could act as a support level here. Now we're seeing some weakness. The green line, which is really hard to see because it's jumbled up here with the bar chart, that's negative. That's short term. The blue line crossing below the red line is turning things more negative as well. So according to this chart, we need to see a bounce up out of this to salvage the positive look that this chart had been giving us. If we drop below the cloud, which we did in early January, and things were looking negative then, but were able to recover up out of that. But this is going to look more negative if we fall below here. This is what I've also been pointing out as long-term overhead resistance. The upper trend channel going back to 2009. We just are having a difficult time getting above that and staying above it. All right, so we are now negative with the Heikin Ashi. We're pointing down with the black candles. We're negative with the Kegi chart. It's red and going down. The Renko chart has now turned negative with the red blocks, and we're now negative with the three-line break chart. So all of our trending charts have switched over to negative. And we have some new O's drawn in here with the point and figure. There was enough of a downward move below 6,000 to put in three O's right here. No signal has been generated yet, but this is more negative when you see O's. When we're going up, that's when you see X's. Long term, we're still holding up okay. We're not really showing a lot of strength, but not a lot of weakness when we look at the 150 and 200 period moving averages. And we're negative in the short term with all the different stock indexes. We're still negative in the intermediate term with the mid caps and the small caps. And we're now back to positive in the short and intermediate term with bonds based on price, as interest rates have been going down with bond prices going up. Commodities are still positive across the board on all time frames. And now the dollar has been in a short-term downtrend. Now it's also in an intermediate term downtrend. A lot of red here. The only blue or green was the euro crossing above 150. Well, that means the dollar's going down. But then we had the NASDAQ below 19.2, 19.1, 19,000, 18.9. And then we had the materials having a BPI cross below 30. That's quite negative. Utilities had a bearish MACD crossover. Canada's getting hit a little bit. That's TSX. And we had the energy ETF have a bearish MACD crossover. So some of these, like energy here, that's more defensive. And the fact that oil's dropping, it actually fell under 70. And that could help the market if this keeps going down. In fact, it says it right up here. We crossed below. For some reason, this was generated later in the day here. Okay, and then the equal weight went up. That actually advanced a little bit. That's a red line where the S&P was down almost 0.5%. And then we look at the ratio. This is really coming down. That means the weighted version of the S&P is underperforming the equal weight version. If we can turn and go back up, that means the mega cap and growth stocks will be coming back more into favor. If this continues to fall, that means they'll remain out of favor. And the Dow still having a difficult time with its 50-day moving average, still negative with the Elder's Impulse system. And we were down another 1.35% with the NASDAQ. We closed a little bit above this pivot point still here for February. We're still above the 200-day moving average, but we're falling further below the 50-period moving average. And we're falling 1.25% here with the NASDAQ 100 as the growth areas are really getting hit. We're negative with the QQQs with the Elder's Impulse system. The momentum for the NASDAQ 100 is negative. And here's the QQQ itself, where we fell below the 20-period moving average. That's short-term negative. Then we fell below the 50. And so we're just continuing to decline here. And small caps just not doing very well, but they were up 0.11% here underneath the 200-day moving average with the S&P 600, where this ETF was actually down. This is the Russell 2000 small cap index. That's continuing to fall below its 200-day moving average. And we're negative with the small caps with the Elder's Impulse system. The mid caps dealing with their 200-day moving average. So far, that's holding for right now. And we're negative with the mid caps with the Elder's Impulse system. Another 0.5% decline with the Wilshire 5000, which is a broad market measure. Another 0.54% decline with the total US stock ETF as we fall a bit further under the 50-day moving average. But we did close up off of the low. If I go back up here, you can see where we set the weakness earlier, right at 59,000 here. And then we were able to bounce up off of that. And we're seeing a little bit of a bounce. It's kind of hard to see where we did close up off of the low, even with the total US stock ETF. So there is some possible improvement coming in. Now, this is a little bit of a concern. This means that staples are really spiking and outperforming tech. We're still seeing this ratio going down, but if this continues to go up, that will mean that the defensive restructuring is continuing, and then we will eventually see a golden cross with this ratio. So we don't know. But we've seen similar things to this before, not so long ago, over the summer, and then it was able to turn and start to go back down. Financial sector virtually unchanged, still above its 50-day moving average. So that's good. We like that. That's positive. The FANG index, Facebook, Apple, Amazon, Netflix, Google, Nvidia, continuing to fall further below its 50-day moving average. Apple virtually unchanged, or Amazon just it had been getting hit here, but this is actually kind of positive because it was down solid. But then it gained all that back and actually ended up being up 0.04%. Where Microsoft is down 1.5%, we're starting to see another potential death cross here. And the longer we stay below both of these lines, the more likely that death cross will be. Google coming down and dealing with its 200-day moving average. Now, this has held up at other times. Is it going to hold up now? Meta coming down and dealing with its 50-day moving average, and Nvidia dealing with its 200-day moving average and about ready to report earnings. Tesla just getting hammered down 8.39% and not even down to its 200-day moving average, at least yet. Netflix coming down and dealing with its 50-day moving average and did close up off of the lows. And we're seeing a real weakening here as actually international stocks, that's the black line, or world stocks, these are actually doing better as US stocks have been coming down. And we're flat to slightly declining with the longer term correlation between US and world stocks. Falling under 70 here with oil. And the dollar is still in an uptrend the way I measure it, but we're still below its 50-day moving average. And we're going down with the 10-year yield, but that's not really helping stocks, at least yet, or to this point. And we're going up with the 7 to 10-year bond ETF. That's based on price. Now, I wanted to show this because we haven't seen this in a while. This is the 10 to the 3-month yield curve. Now, we have not gone inverted again yet, but we're getting pretty stinking close. So if we drop below this line here and go inverted, that could be another inverted yield curve that we're dealing with here. We don't know, it could readjust and start to go back up, but if this drops down below this, this is usually a recessionary signal when because when we went inverted, and we were inverted for a long time, this went inverted back in 2022, and we finally went back to being uninverted, and now that's supposed to start the countdown into a recession. Well, if we go inverted again and then switch back, that's going to start another countdown. Now, this is the 10 to the 3 month. Some folks think this is the most important yield curve to follow. What most of the market follows is the 10-year to the 2-year yield curve. That's not gone inverted now. That's why I'm not showing the chart. So people ask me, which one's more important? I'm like, yeah, both. I follow both of them. And so why not? Instead of just saying this one's better than that one, just watch both of them and see what happens. And we actually came down a little bit with the 10-year yield in Japan, but we're keeping an eye on this because this is what caused the problems last summer. All right, and we're seeing weakness here with our growth to value ratios. The Qs to S&P, discretionary to S&P, large cap growth to large cap value, all declining right now. Large caps going down, mid caps going down, small caps going down. And we're going up here with the Staples to S&P ratio. Again, the overall context is we've been declining here. With this really going up, yeah, that's a concern. But is it going to spike out and turn and start to go back down? That could be more positive for the S&P if we finally spike out with the staples. All right, so what's our outlook for Wednesday? NVIDIA will report on Wednesday, and I believe that's after the close, but I don't follow that stock all that close other than looking at a price chart once a day, so I could be incorrect about that. We are negative in the short and intermediate term, and now we're seeing a trend that continues to develop, and that's a negative trend. We're going to get the MBA mortgage applications index and new home sales, and then all the crazy stuff going on in the world to see if that has any impact on things. And then on Thursday, we're going to get initial jobless claims as well as continuing claims. The second reading of GDP, we'll see if the number's drastically different than the first one we saw. Durable goods can also have a bit of an impact. And then the big one's going to be on Friday with the core PCE. Here's another look at the economic calendar for the week. Seasonality, we're neutral to positive with the Dow and S&P for February 26, and we're just flat out positive with the Nasdaq. This goes back to 2002. So we'll see. Are we going to stick with seasonal patterns? We are dealing with the week after options expiration, which we can pretty much flip a coin here. 49% down, 51% up. And this is the little bounce that we often see, not only if it's a regular year or a post-election year, but we do see some weakness then going into the latter part of February. And this is the second half of February here, which tends to underperform. This also shows how February tends to underperform. Then after an election year, February is the worst month of the year. This also shows where February is the worst month of the year. And then we look at the negative things where accumulation distribution, that's positive. But I like to keep the smart money indicators together. But the idea is that it's been declining, even though it was pretty much flat in Tuesday's session. Where the Chaikin money flow and the Chaikin oscillator, they're negative. And we're going up with the 5 and 10-day equity put-call ratio. That's negative. And the NYSE McClellan Oscillator and Summation Index, that's still negative, even though it ticked up a little bit, where the S&P is now positive. The parabolic SAR is negative, as is the Swindler Trading Oscillator, the bullish percent indexes, and we're negative now with our momentum oscillators. And the Copic curve is also negative. And the ease of movement, even though it advanced, it's still below zero. And the ultimate oscillator is now turned negative, and the vortex has switched back to negative after switching over to positive. Crazy, crazy. All right. And then the momentum for the NASDAQ 100 is also negative. Positive side, I mean, the longer term trends for growth of value and discretionary to staples, they're still positive, but we're seeing them just get weaker and weaker by the day now. And we're going to have to see if that's going to continue. And our advanced decline lines, We're positive with the S&P, and that actually is holding up. It's the rest of the markets that are showing some weakness, though, but we're still positive. That's why it's on the positive side here. We did cross back above the midpoint with the S&P McClellan oscillator, which is slightly turning the summation index based on price up, but we're declining based on volume. And the money flow is positive as well as the financial sector. So our conclusion, we're still negative in the short and intermediate term. The trend is just still developing here, but the long term is still positive, and that's what we're seeing pretty much across the board here. We're below the 50 period moving average, and so far the 100 period moving average is holding. That applies more to the intermediate to even a little bit long term, and we still continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.